Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. 90-day reprieve. Markets rally after President Trump announces a pause on higher tariffs for most nations. Stocks staged their best rally since 2008, with the S&P rebounding from bear market territory. Goldman Sachs reversing their forecast of a U.S. recession. Tit for tat. China not spared by Trump's reprieve. Its tariffs hiked to 125% as the trade war between the world's two biggest economies pushes them towards decoupling. And we have plenty to discuss this morning with our guests, Banque Syz CIO Charles-Henri Monchau and Change Global's Thea Jamison on the markets. And we'll dig deep into China with NYU's Winston Ma, who was formerly of China Investment Corp. Well, it has just gone 8 a.m. across the Emirates. I'm Jemana Versace in Dubai. Well, you know what they say. What goes up must come down. That's the law of gravity. Apparently, it's true for tariffs as well. Reciprocal tariffs, we got the climb down that the market was looking for, a 90-day reprieve on those reciprocal tariffs. So markets really took to that jubilantly. But of course, with one exception, China, the tariffs there have gone up to 125%. And by the way, as of a few minutes ago, well, actually 1 minute ago to be precise, those much higher tariff rates on Chinese goods have gone into effect now, 125%. So that is a big deal for Chinese markets, and we are keeping track of that. But the bigger picture yesterday was that bigger, broader reprieve for most nations around the world. And take a look at the price action. So today we've got futures leaning towards the red, which is somewhat surprising, down 0.7%, NASDAQ down 1.5%, but coming off record days, a massive jump for both of these indices, the biggest jump since 2008. S&P soared nearly 10%, NASDAQ up 12%. Magnificent Seven were up 14.4% yesterday, the biggest single-day jump on record. We're almost back to where we were pre-Liberation Day event last week. Chip makers up 18.7% yesterday. All of that happened in yesterday towards the end, the last final hours of trading. Today, markets taking a bit of a breather, but European markets, take a look at that. Futures pointing to an open of plus 8%. And of course, the reason we're seeing such a stark reaction is the news came out after European markets were closed. So we're playing a bit of catch-up there. The handover from Asia-Pacific today, also very positive, up 5%. Countries around that part of the world breathing a sigh of relief that reciprocal tariff rates have been reduced. Of course, not the case for China. Flipping over, the big, catalyst, or one of the major reasons why the market was so spooked out yesterday was the price action that we saw in treasuries. Today, things are looking a lot more orderly. Remember, this time yesterday, we were close to 4.5%. We sold off 40 basis points or so in about 24 hours. Things have come down again. 10-year treasuries now 4.27, 5 basis points lower. So remarkable moves, really. But things are moving in the right direction from the bond market's perspective, things stabilizing. The USD still dipping, so that theme remains intact. Even though we saw a little bit of a spike after the news came out yesterday, the USD continues to come under selling pressure. We're down about 5.4% on the year on a basket basis. So the USD still is being sold into. And then Brent, interesting today. So we shot back up to $65. Today we're coming off a little bit, 1.3%. But remember, for Brent, the catalyst, of course, were those universal tariffs of 10%, which is still in place, and the fact that OPEC Plus have increased the supply that they're putting back to the market in May. So some of those factors is still persisting, which is why you're seeing a bit of weakness still in the oil market this morning. And then gold getting close once again to all-time record highs, up 1.4% this morning. Flight to quality, safe haven, geopolitical concerns, all of those reasons money is going back into bullion. Okay, but let's get a deeper dive on how markets in Asia are faring. Avril Hong is in our Singapore studio. And Avril, just walk us through the price dynamics this morning. And of course, bearing in mind that those tariffs on China, those higher level tariffs of 125%, the reciprocal tariffs that China put on U.S. goods of 84% have just come into play.
Yeah, we've seen these tariffs, 125%, as well as the 80+% ones take effect just a short while ago, as you say. But note how Chinese stocks were still partaking in that relief rally. It's this idea that authorities will come through with stimulus. And indeed, if you look to the likes of sources that spoke to Bloomberg, they also indicate that Chinese authorities later today are going to have a meeting on stimulus stimulus measures, and it's said to be focused on support for the housing, consumer sectors. So that's the picture on Chinese stocks, even though the Hang Seng paired gains from earlier. We are also seeing the renminbi managing to recoup some of the earlier declines. But of course, this pales in comparison, what you're seeing in Chinese stocks, to what we're seeing in the rest of Asia, that relief rally that's underway, which prompted some of these export-related economies to kind of heave a sigh of relief. It gives them more negotiation room, a bit of wiggle room as well, given they're going to get a bit of that extension of 90 days. So the likes of the TAIEX jumping by the most on record.
Yeah. Astonishing, but perhaps not so astonishing if you take a look at the chip makers yesterday, up almost 19%, the semiconductors in the U.S. So just really, really remarkable moves. Eva Hung in Singapore. But let's go back to our top story. President Trump announcing a 90-day pause on higher tariffs that hit dozens of trade partners after midnight, while raising duties on China to 125%.
I did a 90-day pause for the people that didn't retaliate, because I told them if you retaliate, we're going to double it. And that's what I did with China, because they did retaliate. So we'll see how it all works out. I think it's going to work out amazing. I think that our country is going to be at the end of a year or shorter, but I think we're going to have something that nobody would have dreamt possible.
For more, let's bring in Bloomberg's Bill Ferries. Well, Bill, people are calling these different things: a reprieve, a pause, a climb down, Trump blinking. What happened? Why did President Trump change his mind?
Well, it's certainly, whatever you want to call it, a step back from a very, very high cliff. President Trump himself, in that discussion with reporters that you just showed there, said that he had been watching the bond market, among other things. And he said that he saw that people were getting, quote, yippy and stepping out or getting out of line and really feeling nervous about where the bond market was going yesterday, as we saw kind of a global sell-off of the longer dated notes. And he was also obviously hearing from a lot of people close to him, people who helped his campaign, like Elon Musk, hedge fund manager Bill Ackman, and senators like Lindsey Graham. So they were all reaching out to him in the hours and days ahead of that deadline that hit yesterday, expressing their concern about what this would do to the global economy. Some saying, listen, take the win. You've got countries calling you, looking to make deals. Put on this 90-day pause and see what you can get out of it.
Yeah, and yet the 10% broad tariffs are still being applied, and the situation with China is worse than it was 24 hours ago. Those higher tariff rates have just come into effect now. A few minutes ago, 125% on Chinese goods, 84% on U.S. goods into China. So has the focus of this, I'd say, trade recalibration that the Trump administration is trying to achieve now shifted towards a simple trade war with China?
Yeah, absolutely. I think you're going to have two things going on. One are these countries that were looking at higher tariffs going to Washington, trying to cut deals so that at the end of that 90-day pause, they aren't facing 40%, 50%, whatever it was they were staring down at. And the second part of that is probably the more important part. You have huge tariffs on Chinese goods. You have almost equally huge tariffs on American goods. This is a $700 billion trade relationship, and it's not just about the final products on the shelves in American stores, but it's about all those goods, the machinery, the intermediate goods that American companies need if they want to fulfill Donald Trump's goal of moving production back to the U.S. We know that there have been 1,100 requests so far to the USTR for exceptions to those trade barriers. That's going to be a big question going forward. Bloomberg Economics says 100% plus tariffs could effectively end bilateral trade with China in the medium term. So it could still be a very rocky road ahead in the weeks to come.
Yeah. Remarkable stats there. Bloomberg's Bill Ferries, thank you so much. Well, to discuss markets and the market reaction and beyond, joining us is Charles-Henri Monchau, the CIO of Banque Syz. I was just going through the really remarkable moves that we've seen in stock markets and other financial assets the last 24 hours. Do you think this 90-day pause is enough for a change in sentiment? Are people going to feel a lot better about where things are headed, stock markets? And come back into risk-on trades again?
But let me, share with you the good, the bad, and the ugly of this. The good thing is that we started the day yesterday very close to a true financial crisis with all of this stress in the bond market. At least this is putting an halt to this, and that's great. The bad thing is who can deal with it? We started the day talking about this basis trade stress in the bond market, and we ended with a 12% increase in NASDAQ. For investors, this is very difficult to manage. They're going to ask anyway for a higher risk premium. And think about the CFOs and the CEOs. We're going to hear about this during the earnings season. And the ugly part is that this is all about China. Yes, there is an 90-day pause for the orders, but we're talking about 125% tariffs on China, effective now. It's still $500 billion of revenues for the US, but this is the equivalent of the biggest tax hike in 50 years. It's still around 19%, 20% of effective tax tariff rates. So that's still pretty high. So the relationship between the US and China was breaking. It is now broken with all of the consequences on growth, on inflation. And that's still something that we need to keep in mind as money managers.
And obviously it needs time to work through what all of this is going to mean, right? He's announcing these things. The markets are reacting very quickly, but the actual economic impact, the impact on the real economy is going to take months for people to digest. Do you think there's a situation now where, because of there's still a lot of policy uncertainty in the US, that it actually opens up an opportunity for the rest of the world to outperform?
Well, we believe that this great rotation trade with capital flows moving out of the US into Europe, into Asia, still has room to go. And we have been adapting the portfolios, to play that. That being said, in the long run, the US keeps some true competitive advantage, lower energy prices. They still have the biggest defense in the world. They are still a reserve currency. Return on investment capital of the company is still higher. But again, I think it's the rule of the game this year is about diversification. Yeah. It's about quality, avoiding leverage. So I think at least if we stick to these simple rules, maybe, we have better nights than others, and that's the goal for
I thought it was interesting that both yesterday, so reciprocal tariff day, which lasted, less than 24 hours, you saw actually Chinese onshore markets do okay because there was some stabilization, some help came through locally. And today there's talk that China may come out with further stimulus. There's talk of interest rate cuts. Obviously, we're all keeping a close eye on the fixing. So China have a plan of what they want to do to stimulate, to counter the effect of tariffs. What's the U.S. going to do to counter the effect of tariffs? So
they are forcing the world basically to move some of their manufacturing capabilities in the U.S. And by doing so, yes, indeed, there is no tariffs, which means that there is no inflationary impact. Is it possible for many companies to do that? I think it's going to be very difficult. But I think just to keep one example, I'm coming from Switzerland. We have a company called Nestlé, which is selling 95% of the goods they are selling in the US are manufactured in the US. The impact on the inflationary side with the tariffs is null. But there are so many companies who are still manufacturing all of the US. And it will take time, as you mentioned, to turn around and prepare for that. So we still believe that the inflationary impact in the US is going to be quite high. What they can do to offset some of the effect of these $500 billion, equivalent tax hike is indeed to decrease corporate taxes, individual taxes. We should hear about that in the coming weeks or months, and it's much needed. Because indeed, the effects, the net effects on the economy is something negative. So we didn't have, this recession scenario as Goldman had, and they changed their mind, by the way, yesterday very quickly. But it still means that we're going to see some slower growth in the US, probably higher inflation, and they will need to play between fiscal and monetary policy.
It's ironic because the tariff situation is effectively a tax hike. And so to compensate for that, they actually need to introduce tax cuts. Where are they going to fund that? How are they going to fund that? And should there be more fiscal premium once again in the U.S. yield curve? But Scott Bessent wants the deficit to be 3%. That's not going to be achievable.
Yeah, I think there are so many targets that reaching all of them will be very difficult. And this has to uncertainty, by the way. But as mentioned, $500 billion revenue is a big war chest, in terms of liquidity to be reinvested into the economy through tax cuts. What we also saw yesterday, what was very interesting, is there has been a tweak in terms of his team of economic advisor. It seems that Navarro is on the sideline now. You remember these comments by Elon Musk 48 hours ago. So it seems that he is on the sideline, that Scott Bessent is coming back with a bigger role. So that means that there is indeed more also focus on the Treasury side. So
I guess people see Bessent as representing the voice of the business community because he was once a hedge fund manager, and so it looks like that team won out because of this financial market volatility. And
when it comes to the fiscal side, let's not forget also the bond market, because he's very obsessed about the bond market. He's probably intimidated by the bond market, and this is why he took this decision. But we are still around 4.3% on the 10-year with $8 trillion of Treasury that needs to be rolled out this year. So that's going to be
Was it Volcker who said when he dies he wants to come back reincarnated as the bond market? Well, there you go. Never fight the bond market. Charles-Henri, always good to chat to you. Charles-Henri Monchau, CIO of Banque Syz. Now, coming up, the Rand rebounds after President Trump's tariffs pause. We cross live to Johannesburg next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Versace in Dubai. The South African Rand advanced 2.8% after President Trump announced a pause on tariffs on most nations for 90 days. And of course, there was a relief rally across so many assets around the world, including emerging market assets. Bloomberg's chief Africa correspondent Jennifer Zabazaja joins us from Johannesburg. Jen, a roller coaster week of activity for financial markets globally, but maybe just walk us through some of the price action that we've seen specifically for some of the African nations that you follow and what's been happening with the bond markets over there.
Right, Jumana, volatile, I think, is a really good way to put it. You did mention we did see a bit of a rebound for the South African Rand and some of the other assets in the South African market. But yeah, if you take a look at some of the price action that we have seen from the bond market, it's been quite significant and substantial, some of the swings, similar to what we've seen in the global bond market. African bonds really plummeting over the past few days. If we just take a look at one of them, Angola is one that we are really zeroing in on. Angola has a $1.75 billion bond that is maturing in 2032, actually hit the highest yield since 2022. That was earlier this week. Senegal's, the yield on Senegal's bonds also maturing in 2031, rising by 43 basis points to 14.2% on Wednesday. That was the highest for Senegal since that bond was issued in June of last year. We were also paying close attention to Nigeria, which is, of course, the biggest oil producer, or one of the major oil producers on the African continent, and Zambia, which has been one of the countries that has been a focus for the common framework in their own fiscal situation, also seeing their bonds plummeting over the past few days. So we did get some somewhat of a stabilization. I know you were just talking with the guest about what we saw from the global bond market after we did get that about face from President Trump. But the issue here for African countries is there are so many compounding problems that they are facing. It's not just trade concerns. There's also falling oil prices and potentially, potential revenue shortfalls for a number of these countries. So the fact that their bonds are dropping by so substantially could be an issue for them longer term.
Yeah, no, most definitely. And it's pretty stark price action if you look at what has happened there. So you're talking about not just an absolute yield level move, but also a credit spread move. How do these market swings and the fact that the bond prices have dropped so much affect some of these countries' fiscal positions, Jen?
I think one quote that is probably that could sum this up really quite well is coming from the IMF, which is earlier this year. We did hear from Abebe Salisi, who manages the African department at the IMF, saying that they're not ruling out the fact that they could see more African countries coming to the institution for support because of a lot of this uncertainty. But then we should also remember that the U.S. aid to a number of these countries was also cut. So that is just coming from the IMF, a number of African countries already in IMF programs as it stands. But as I was mentioning to you, Jumana, a number of countries had actually just started getting into the opening innings of returning to the foreign market and actually issuing bonds after being shut out in 2022. And so we've seen Ivory Coast, we've also seen Kenya and Benin being some of them. And executives I've spoken to were hopeful that we were going to see more of that. But if we could continue to see a lot of this volatility, it might make it difficult for any of these countries to return back to foreign markets. But not just that, even repaying some of these loans, considering a lot of the currency depreciation that we've seen across the continent, could make it that much harder. And again, for a country like Nigeria and Angola, who are experiencing falling oil prices, that will create revenue shortfalls for them. So really a difficult fiscal position that a number of these African countries that we pay attention to
and still
are facing.
A lot up in the air. Yeah, and it's still a lot up in the air, despite that many of these reciprocal tariffs have now been postponed for 90 days. A lot of questions still, and that seems to be the theme of the day today. Jen, thank you so much. Great reporting. Jennifer Zabazaja, Bloomberg's Chief Africa Correspondent. Okay, let's take a quick check on how these markets are faring, because we're coming off yet another record day for the S&P yesterday, the biggest bounce since 2008. That index was soared nearly 10% by the end of the day. NASDAQ ended the day up 12%. But today, futures are dipping a little bit. But check out European markets. Those are going to open deeply, deeply positive. So up 8% when the market opens in a couple of hours' time. And then the handover from Asia Pacific, very, very positive as well, up 5%. Taiwan leading the way with that index up more than 8%, a strong rebound for chip makers. So we're going to keep an eye on this price action throughout the rest of the show. This is Bloomberg. Iran's president says his country will provide what he describes as any necessary guarantees that it does not want to develop nuclear weapons. Masoud Pezeshkian's comments came as Tehran prepares for a new round of nuclear talks with the U.S. Meanwhile, President Trump has threatened to use military action against Iran if it tries to acquire a nuclear weapon, but added that Israel would be the leader of any potential strike. And Turkey is reportedly holding technical-level talks with Israel to ease tensions over Syria. Israel has launched multiple airstrikes and ground incursions in Syria as it aims to keep Syrian forces away from its border. Turkey is a key backer of Syria's government following the toppling of Bashar al-Assad in December after almost 14 years of civil war. And coming up, our next guest says emerging markets were prepared for tariffs. Thea Jamison of Change Global Investment explains why next. This is Bloomberg. Good morning. This is Horizon's Middle East and Africa, our top stories this morning. 90-day reprieve. Markets rally after President Trump announces a pause on higher tariffs for most nations. Stocks staged their best rally since 2008, with the S&P rebounding from bear market territory. Goldman Sachs reversing their forecast of a U.S. recession. Tit for tat. China not spared by Trump's reprieve. Its tariffs hiked to 125% as the trade war between the world's two biggest economies pushes them towards decoupling. And we have plenty to discuss this morning with our guests. Change Global's Thea Jamison on the markets is just ahead. And we'll dig deep into China with NYU's Winston Ma, who was formerly of China Investment Corp. Well, it's just gone 8:30 a.m. across the Emirates. I'm Johanna Versace in Dubai. Mega rally for stock markets yesterday. The S&P ending up almost 10% higher, its best day since 2008. So much volatility this week, and amazing how sentiment can change just over the course of 24 hours. But of course, the major bombshell announcement was that the Trump administration is introducing a 90-day pause, a reprieve on the imposition of those higher reciprocal tariffs that went into effect, in theory, yesterday. So we've got a 3-month window to get deals done. But the one exception, of course, was China, where just in the last half hour, those higher rates of 125% did actually go into effect. So the trade wars, so to speak, between U.S. and China is still very much on. For the rest of the world, it's been taken down one notch in terms of intensity, but those broad tariff rates of 10% are still in place. So that's something to bear in mind. So with that, let's take a look at how markets are faring, because S&P futures are coming off a little bit this morning, down 0.8% after yesterday's massive jump of 10%. NASDAQ futures also down 1.4%. Bear in mind, yesterday, Magnificent Seven stocks jumped 14.4%. That's the biggest one-day jump on record for that group of stocks. Chip makers up 18.7%. So very strong price action there. Not translating to the U.S. future session in the overnight. But European markets look like they're going to have a very strong open too, up 8%, just playing catch-up given they were closed when the news came out. And then today, most of the handover from Asia-Pacific has been very positive as well, up 5% from this MSCI Asia-Pacific basket ex-Japan. So very strong handover. Let's switch over, though. The catalyst of so much of yesterday's sort of risk-off sentiment and nervousness came from the bond market. Today, things are looking a lot more orderly. We're down about 6 basis points. And of course, this time yesterday, we were up at 4.5%. So we've come a really long way back to levels we were at on Monday, but still some nervousness in that part of the market, given we were very close to things beginning to look disorderly in terms of how bond markets were trading yesterday. USD dipping down 0.4%, and then Brent as well, even though we jumped back up to $65, still coming off this morning. Same issue still persisting. You've got worries about global demand and the fact that OPEC Plus surprised the market with that extra supply decision last week. So that continues to weigh on the sector. And then gold almost at all-time record highs again, 1.4% firmer. But let's go back to that price action out of Asian markets. We are seeing a bit of a relief rally today. Avril Hong is there in Singapore with all of the latest. Just run us through what you're seeing, Avril.
Yeah, Jumana, I mean, that relief rally is really stark in the likes of the TAIEX. We're seeing it jumping by the most on record. 90 days, it's going to give them a lot of wiggle room to talk things through. So you see that reprieve, but we're also keeping an eye, of course, on Chinese stocks as they enter the lunch break. They quite significantly pared their earlier gains, and this is despite all this talk about potentially authorities today meeting to talk about stimulus that will be potentially directed towards the housing, the consumption-related sectors. The key thing here is how the tit-for-tat measures have kind of spurred the speculation about stimulus support from Chinese authorities. Keeping an eye on the renminbi as well, because it's turned out to be a bit of a relief valve when it comes to the US-China tensions. Note that today the PBOC weakened the yuan fix yet again. Keeping an eye as well for us in this part of the world on some of the emerging markets, such as Vietnam. It was among those that were hit the hardest on the tariff front by Trump, but if you look at how the gauge is faring today, it's jumping by the most since the year 2001. Jumana?
Well, yeah, so big gains, more superlatives around the globe, but another really volatile week for trading. Avril Hong in Singapore. Well, speaking of, emerging market assets rebounded after President Trump announced a pause on tariffs for 90 days for most nations. Joining us now is Thea Jamison, Change Global Investments Managing Director, fresh from her trip to Vietnam and China. Timely to talk about those countries, I would say. Avril was just saying that the Vietnamese stock market index is seeing its biggest jump since 2001. I know you were there before the reciprocal tariffs came into play, and obviously things have changed once again in the last 24 hours. But how much of a blow do you think it is to Vietnam that these tariffs were even discussed in the first place? And of course, now they're sitting at a 10% tariff rate.
Well, it's really interesting. I was in Vietnam just about 3 weeks ago, and I was visiting the industrial parks where the global multi-tech companies are building and expanding. And the trip was truly a reminder of how incredibly competitive the country is, but also how those projects have been in place for a long time, and these are the results of long-term relationships.
Yeah.
For example, on the competitive end, land is cheap. There's access to cheap power.
Yeah.
And wages are roughly $400 a month.
Yeah.
So regardless of the level of tariffs, Vietnam remains very competitive.
For sure. But then I guess it raises a question of who's going to buy Vietnamese goods. If the reciprocal tariffs had gone into play, you would be looking at Vietnamese goods charged at a levy of 45%. That's a lot more expensive for U.S. consumers than they would have been in the past. Does
Correct.
Vietnam have the ability to find different markets, maybe closer within the Southeast Asian region, other consumers that can compensate for the hit or the anticipated hit from the U.S. consumer?
Yeah, I mean, absolutely. So one of the reasons why these markets have been so resilient, and Vietnam in particular, is they are trading more with each other. For example, 25 years ago, emerging markets such as Vietnam only traded roughly a quarter of their exports with other emerging markets.
Yeah.
Today, that share is nearly 50%. So there is some resilience built in and diversification.
So you went to China as well. Interesting. I'm very curious to hear your takeaways also and just what sentiment is like going into this year. So many unknowns, but again, the last 24 hours, people are coming around to the view that there is going to be a lot more stimulus to counter the effects of the tariffs and even also to deal with the ongoing structural issues in the Chinese economy vis-a-vis the property downturn. What was your impression from your trip?
Yeah, so on the ground, the focus is entirely on domestic levers. In China, roughly 70% of the wealth effect is tied to real estate. So it's incredibly important to get the real estate market going again. Last year, there were over 800 domestic policies specifically targeted at real estate. And you're seeing some bounce back, at least in transactions. Transactions in the big Tier 1 cities are up over the course of last quarter pretty significantly, albeit off of a low base, but still moving in the positive direction. And then also a tremendous amount of focus on sentiment, consumption, stability of incomes, and already seeing some positive signs there.
So just reading between the lines of what you're saying, the bullish long-term thesis is still there, right, for some of these emerging market economies that you visited. How do you navigate the short-term volatility?
So in the short term, we're very adamant about global diversification, similarly to what the big corporate manufacturing companies are doing. We're also focused on diversifying that country regional risk, deploying assets in domestic stories to the extent that we can. And the Middle East is a terrific example of domestic reform and idiosyncratic risks.
Yeah, so are you, given you brought up the Middle East, people now are keeping a close eye on what's been happening to the price of oil, saying it's going to exert some pressure on countries' budget deficits, and specifically the Kingdom of Saudi Arabia. How do you think about the interplay between what's happening with the global economy, global demand outlook, and what would happen in this part of the world as a function of that?
So it's really interesting. I'm looking at the domestic market, and there has been tremendous amount of growth. I'm here for the EFG Hermes conference, and the number of corporates has increased by 20% in just 2 years, as far as the tendency is concerned. Not only are you seeing a growing universe, but you're also seeing tremendous amount of improvement in disclosure. Some companies have never had IR departments, and now they're making an effort to reach out to the investment community. So we're looking for that kind of structural change. We're looking for reform-oriented markets like Egypt, which has liberalized its currency market. It has removed subsidies. So there's a lot to be excited about. And of course, the UAE, where you're seeing dramatic diversification of the economy. Heineken building a brewery plant here. It's pretty fascinating.
We spoke about that on the show. Actually, it's funny that you picked up on that one. Thea, great to chat to you. Thank you so much for coming on our show and giving us your perspectives from her recent trip to Asia. Thea Jamison, Change Global Investments Managing Director. Thank you. Well, coming up, markets are moving on news that Trump is placing a pause on higher tariffs for trade partners and raising duties on China to 125%. More on those developments with NYU School of Law next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Versace in Dubai. President Trump has announced a 90-day pause on higher tariffs that hit dozens of trade partners after midnight, while raising duties on China to 125%. And by the way, those just went into effect at the top of our show about 43 minutes ago. So for more on our top story, Winston Ma, Adjunct Professor at NYU School of Law, joins us now. You worked at CIC.
China's Sovereign Wealth Fund.
Sovereign Wealth Fund, yeah, thank
Yes.
you. You said it on me. So you have a lot of insights into perhaps how China's thinking about all of this.
Yes.
They're still very much in the eye of the storm. So yes, things have de-escalated for other countries around the world, but things have escalated
Yes.
for U.S. and China. How do you think they are thinking about how to retaliate and what to do to counter the impact of the tariffs?
Right. China says it will fight to the end.
Yeah.
Right. So in the short term, it needs to shift the original consumption purchasing from the U.S. into domestic consumption.
Yeah.
Right. So that's why the street talk about China is thinking about a stimulus package right now.
Yeah.
Now, put it into context, right? There was a lot of expectation of China stimulus for a long time, because after COVID, there was a slowdown. There was expectation for stimulus, and recently, because of the U.S.-China trade war, there was a talk about stimulus in the latest government report last month.
Yeah.
So essentially, the China stimulus has been overdue, and the stimulus was already set, and now it is only natural that China will accelerate that stimulus right now in the face of this escalation, as you described.
Yeah, and I think that's the market expectations.
Yes.
And yet, if you look back at China's GDP of last year,
Yes.
30% of its GDP came from exports. That's not going to be easy to compensate for.
That's true. But the good thing is China did not do lots of stimulus during the COVID time, right? Because if you compare to the U.S., China did not cut rate during the COVID time. And even after the COVID, during the slowdown time, China did not send a stimulus, did not send money to individuals to promote consumption, just like the U.S. did. So China overall has more room to use stimulus monetary tools for short-term relief.
Is it your expectation that China is actually going to benefit from this sort of new geopolitical realignment? Many countries around the world are waking up today and thinking, whoa, I mean, this has been really difficult with the U.S. and dealing with the volatility of the Trump administration. Maybe we should actually start thinking to renew or reinvigorate our relations east. Do you think China may actually prove to be a beneficiary out of all of this?
Yeah, it's hard to say beneficiary, but it does give China a place to talk, right? Because even Trump himself, right, today offered to talk with China. I think for many people, now speaking from a sovereign fund perspective, right?
Yeah.
Many people forget that the $1 trillion surplus that China got from the U.S., which was the origin of this confrontation, right, actually at the same time created more close connection between the U.S.-China financial markets. What I meant is, right, the surplus from the import-export actually went to the sovereign funds, the Central Bank of China plus CIC, right, which I worked for a few years ago. And those sovereign funds had $1 trillion portfolio in the U.S. capital markets, right? The treasuries and the public markets as well, right? So that means the confrontation aspect is has the mirror image of the financial connection, right? So that's why Trump is offering to chat, and I think that gives China a place to have a negotiation power.
How far do you think Chinese authorities are going to allow the country, the currency, to depreciate without sparking too many capital outflows?
I think they already allowed substantial depreciation since the COVID, which indicates they are no longer stick to any threshold. What I mean is, for many years, people said the exchange rate of 7 to $1 is like this massive, important milestone that China will always defend, right? But in reality, from 7, it's now already close to 7.4, right? So that's like more than 15% or that kind of thing, right? So when you actually more than that. So So going forward, at least for the short term, in order to relieve this export shock, to have a better position to negotiate with the U.S., it may allow the currency to loosen up.
Yeah, loosen a little bit. It seems to be moving on that path. I want you to put on your sovereign wealth fund hat for a moment. The U.S., some of the president's advisors have floated the idea of the U.S. creating their own version of a sovereign wealth fund.
Yes.
How likely is it that that actually happens?
Actually, it could happen more easily than you thought.
Why?
Yeah, because it can get, even though it's a deficit country, right? But it can get resources from several aspects. One, surprisingly, just like the Middle East, right? The U.S. may get the capital from its federal natural resources because at the state level, the U.S. already has Alaska sovereign fund based on oil. Right? Secondly, the U.S. can just put government holdings into a vehicle to create a U.S. sovereign fund, just like the strategic reserve of crypto assets, right? Because when Trump announced the strategic reserve to put all the U.S. government-held bitcoins from civil or criminal lawsuits in one place, essentially created a Bitcoin-based sovereign wealth fund. So it can do similar things for a equity-based sovereign fund, for example, right? Equity holdings. And finally, Trump is very creative in terms of using non-conventional resources to start the sovereign fund, right? So talking about the tariff and also Doge savings and even the golden visa. So he has many ideas to create unconventional source of revenue to start the fund.
Yeah. Well, I wish we had more time, but yes. I would love to talk about what that might mean for the dollar and dollar dominance. But we'll save that for another discussion.
Thank you.
Winston Ma, Adjunct Professor, NYU School of Law. Now, coming up, Tesla is opening up shop in Saudi Arabia. We cross to Riyadh next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Versace in Dubai. Well, Tesla is opening up a shop in Saudi Arabia's capital, Riyadh, seemingly putting an end to a bitter feud between Elon Musk and PIF head Yasser Al-Rumayyan. Bloomberg senior reporter for Middle East Wealth Funds, Matthew Martin, joins us right now from Riyadh. Why is Elon Musk opening up a Tesla shop or opening up shop in Riyadh? The Saudi Arabian consumer market isn't a big one. So what is he trying to achieve?
Good morning. Yeah, look, I think there's a couple of significant things here. I think probably the most significant part of this isn't going to be a big move for Tesla. I don't think we're going to see hundreds of thousands of Teslas being sold in Saudi Arabia very quickly. But I think what it does signal is that this long-running spat that Elon Musk had with Yasser Al-Rumayyan, just on the screens just then in the photos. The two of them spectacularly fell out a while ago over a plan to take Tesla private. A lot of the text messages between the two of them came out in a court case related to that deal, and it really showed that the two had really fallen out pretty spectacularly. And as a result of that, the PIF then went off and backed Lucid instead, a rival electric car maker, and has poured billions into them to try and make them into a rival for Tesla. Perhaps not as successfully as the Saudis might have hoped, but now, of course, Elon's star has been his political star has been rising, even if his business one has not been doing so well over the past 6 months or so, because of his ties to the Trump administration. And so the Saudis, I think, have really wanted to try and fix that relationship with Elon Musk. And this is the latest sign. Tesla coming into the Saudi market is the latest sign that the Saudi-Elon relationship is back on track, and perhaps sets up the opportunity for further collaboration in the future.
Yeah, and of course, let's not forget that President Trump's first foreign visit is going to be to the GCC in a couple of weeks' time. So with that in mind, let me just ask you what this business decision out of Elon Musk and for Tesla means for the rollout of EVs in general in Saudi Arabia. You mentioned the penetration of some of those Chinese automakers. They're now going to have competition from Tesla.
Yeah, look, exactly. I mean, I think, I guess for Tesla, this is probably one of the last big major economies that they don't have an entry into. But it's not going to be like a lot of, North American or European countries where there is much higher emission standards, where fuel is a lot more expensive. I mean, I'm sitting in a country now where it's still very, very cheap to fill up your gas-guzzling SUV, and so this is the most of the cars that are on the streets. We're also seeing if you look around the streets of Riyadh now, there's been a big push towards cheap Chinese cars. The Chinese have really been making a big effort into growing the market here. So Tesla, look, I'm sure there's a niche for Tesla. People are going to want that sort of luxury EV market, but it's not going to be huge. And I think, we'll continue to see, like in other markets around the world, that companies like BYD are going to really give them a run for their money in terms of sales.
Yeah, you were saying it doesn't cost a lot to fill up your gas-guzzling SUV. It's probably a little cheaper now after the price action in oil this week, Matthew. Thank you so much for the reporting. Bloomberg senior reporter for Middle East Wealth Funds, Matthew Martin in Riyadh. Okay, let's round up the show taking a look at how equity futures are faring because they've dipped a little bit. S&P now in the red, down 0.2%. Nasdaq down 1.2% after quite a historic day yesterday in terms of the rebound. S&P ending the day up 10%, and Nasdaq up 12%. And take a look at European markets. 8.2% is what futures are calling for the open. But Tom McKenzie will give you more on that. Daybreak Europe is coming up, but that was Horizons Middle East and Africa.